Welcome back, everyone, to the deep dive. For today's deep dive, we're going to be focusing on stock strategies,
Okay.
specifically for beginners.
Sounds good.
So if you're new to the world of stocks, this is for you.
Awesome.
We're going to unpack a really fascinating strategy called the dual moving average strategy. You might know it as DMA.
Yeah?
And to help us with this, we've got this great video analysis of Bitcoin and Ethereum trading.
Great.
Now, this strategy, it's often referred to as the trader's Bible.
Right.
So we're really excited to dig into it. And the video uses something called backtesting, which is pretty cool. It basically simulates trading with historical data
Yeah.
to see how the strategy would perform.
Interesting.
So we're going to get into the nitty-gritty of all of that.
Yeah, should be fun.
But of course, as with all trading strategies, this is not like a guarantee win.
Right.
You need to understand the mechanics. You need to understand the limitations.
Absolutely.
And always think about risk management. So before we jump into the DMA itself, let's break down this idea of moving averages.
Okay.
Because these are key indicators
Yeah.
that are used in this strategy. And it might sound a little intimidating at first,
It can.
but really they're just tools to smooth out price fluctuations
Yeah.
and help us try to spot potential trends.
Yeah, it's a way to kind of see the forest for the trees, you know?
Exactly.
Not getting caught up in every little wiggle.
Right, just kind of get like a bigger picture.
Exactly.
So we're going to focus on two main types, the simple moving average, or SMA,
Uh-huh.
and the exponential moving average, or EMA.
Right.
Now, an SMA is very simply, it's the average price
Yeah.
over a set period of time.
Exactly.
So let's say you're looking at a 5-day SMA.
Okay.
You would add up the closing prices for the last 5 days
Uh-huh.
and divide by 5.
Easy peasy.
That's it. So pretty straightforward.
Yeah.
Now, what about the EMA? How is that different?
So the EMA is similar.
Okay.
But it gives more weight to recent prices.
Okay.
So it makes it a bit more sensitive or responsive to new market movements.
Got it.
You probably pay more attention to today's news headlines than ones from a week ago.
For sure.
So it's kind of like that.
Yeah, the latest information usually feels more relevant.
Exactly.
So in this case, the EMA is giving more importance to that most recent price action.
Yep.
And that potentially makes it a bit more reactive.
Yeah, it can be a little jumpier.
Okay.
Yeah.
But how do these moving averages actually come into play in a trading strategy?
So that's where the dual moving average comes in.
Right.
You're going to use two moving averages.
Okay.
One faster one with a shorter time frame and one slower one with a longer time frame.
Gotcha.
So let's imagine you've got a 5-day SMA as your fast average
Okay.
and a 20-day SMA as your slow average.
Okay. So I'm picturing two lines on a chart.
Yep.
One is reacting more quickly to those price changes than the other.
Exactly.
So how do we actually use this to make trading decisions?
Okay, so what you're looking for are those moments where those lines cross,
Okay.
because that can signal a potential buy or sell opportunity.
Okay. Interesting.
So when the faster moving average crosses above the slower one,
Uh-huh.
that's called a golden cross.
Ooh, golden cross.
And that's generally seen as a bullish signal,
Okay.
suggesting a potential upward trend.
Interesting. So if I were looking at this chart and I had my 5-day and my 20-day, and suddenly that 5-day line just shoots up and crosses above the 20-day,
Yep.
that might be a sign that, hey, maybe I should consider buying.
That's the idea.
Okay.
Now, on the flip side, when the faster moving average dips below the slower one,
Uh-huh.
that's called a death cross.
Oh, so it's the opposite.
Yeah, a little more ominous sounding.
Right, a little bit.
And that's a bearish signal that could suggest a potential downward trend.
Got it. So that's maybe my cue to think about selling or holding off on buying.
Exactly.
Okay, so it's all about watching for those crosses.
That's the basic idea.
But that seems a little too simple.
Well, it's the basic concept.
Okay.
But of course, there's nuance to it.
Right.
Remember that video analysis we mentioned?
Uh-huh.
They actually put the strategy to the test.
Cool.
They used different combinations of SMAs and EMAs
Okay.
on Bitcoin and Ethereum data to see how effective it really was.
Okay.
And they did this back testing with a specific focus on perpetual contracts.
Got it.
And they set some parameters, a 5% profit target
Okay.
and a 1% stop loss.
Okay, so they kind of set some specific parameters to see how this would have performed in the past.
Exactly.
Okay, got it. But before we dive into those results,
Okay.
could you maybe walk me through a concrete example
Sure.
of how a golden cross or a death cross would actually play out in a real trade?
Absolutely. Let's say you're looking at Bitcoin.
Yeah.
And you've chosen to use the 10-day and 20-day SMAs for your DMA strategy.
Right.
So imagine the Bitcoin price has been trending downwards.
Okay.
And your 10-day SMA is below the 20-day SMA.
Okay.
Then let's say some positive news hits the market and the price of Bitcoin starts to climb.
Hold on. Let me just visualize this. So the price is climbing.
Yep.
And that means that 10-day SMA being more sensitive to recent prices is going to start moving up
Exactly.
faster than the 20-day?
Yes.
Okay.
And as the price continues to rise, that 10-day SMA is eventually going to cross above the 20-day SMA, creating that golden cross.
Right.
And this could be your signal to consider buying Bitcoin,
Okay.
as it suggests that the downward trend might be reversing and an upward trend could be starting.
Okay. I'm starting to see how this works in action.
Great.
Now, I'm really curious to hear what the video analysis actually revealed about how effective these different SMA and EMA combinations are.
Yeah.
Did they find like a magic formula?
Well, let's dive into those results.
Okay.
What's fascinating is that the video highlights how the effectiveness of these combinations can actually vary significantly depending on the time frame that you choose.
Got it.
And the asset you're looking at.
Okay, so time frame plays a crucial role.
It does.
All right, this is where it gets really interesting.
Yeah, let's unpack those findings.
Let's do it. So you mentioned that the time frame plays like a crucial role.
It really does.
Let's start with Bitcoin.
Okay.
What did the video analysis reveal about using DMA on different time frames for Bitcoin?
So they looked at hourly, 4-hour, and daily time frames.
Yeah.
And on the 1-hour time frame,
Okay.
the results were pretty interesting. Only one combination actually generated a positive return.
Really?
Yeah, just SMA5 and SMA20.
Okay.
And it was a modest 10.7%.
Okay.
All the other SMA combinations on the 1-hour time frame actually resulted in losses.
Yeah. So even though those combinations are, kind of popular, they weren't actually profitable in that scenario.
On that time frame.
It seems like time frame really does matter.
It does.
Okay, what about the 4-hour time frame?
So the 4-hour time frame painted a very different picture.
Okay. 3
combinations delivered positive returns. SMA5 and SMA20, SMA20 and SMA60 and SMA20 and SMA120.
Okay.
The most profitable one was the SMA20 and SMA120 combination, yielding a return of 42.81%.
Okay. That's a significant difference in performance compared to the 1-hour time frame.
Huge difference.
So for someone like me, the beginner looking at Bitcoin, it might make sense to start exploring the 4-hour time frame.
It could.
With those combinations that you mentioned.
It could be a good starting point, but remember, past performance doesn't guarantee future results.
Right, of course.
What's important is to try to understand why certain combinations might work better on specific time frames.
Okay.
So what do you think might be the reason for these varying results?
Well, if I think about it like the 1-hour time frame, you're capturing very short-term price fluctuations.
Right.
Maybe the noise of all of those rapid price changes makes it harder for the moving averages to clearly identify a trend.
That's a very insightful observation.
Okay, good.
The shorter the time frame, the more susceptible you are to those just random price swings.
Right.
Which can lead to, false signals or missed opportunities.
Yeah, you're getting caught up in the noise.
Exactly.
Okay.
So let's see what happened when we go to the daily time frame for Bitcoin.
So zooming out even further?
Yep, even further.
What did they find?
So on the daily time frame, the winning combination was SMA20 and SMA60 with a 19.39% return.
Okay.
However, they noticed that when they use SMAs with much larger values for N, like SMA 120 or SMA 180, they end up with fewer data points.
Right.
And therefore fewer trading signals.
That makes sense. If you're looking at a really long time frame, like 180 days,
right,
it will naturally take longer.
It's going to take longer
For those averages to cross.
Right.
meaning you'd have fewer buy or sell signals.
Exactly.
So finding that balance between the time frame and the moving average values is key.
It's all about finding that sweet spot.
Yeah.
Now remember, this was just for Bitcoin. The analysis also looked at Ethereum.
Okay.
And as you might expect, the results weren't identical.
Right, because different assets have different behaviors.
Exactly.
Okay, so let's talk about Ethereum.
Let's do it.
Did any of the same SMA combinations perform well on Ethereum?
Interestingly, some did, but there were also some notable differences.
Okay.
So on the 1 hour time frame for Ethereum, the best performer was SMA 20 and SMA 120.
That's interesting.
With a pretty solid 33.43% return.
Okay.
But when they shifted to the 4 hour time frame, the top spot went to SMA 20 and SMA 60 with a 48.46% return.
So even though we're looking at the same type of strategy,
Right.
DMA, the optimal combination shifts depending on the asset.
Absolutely.
And the time frame.
It does.
This really highlights the importance of not just blindly applying a strategy, but like understanding the nuances and adapting it accordingly.
You got it.
Okay.
And that point's further emphasized when we look at the daily time frame for Ethereum.
That SMA 20 and SMA 60 combination came out on top again.
Okay.
This time with a 5.83% return.
So while there are some overlaps, the best combination isn't always the same across different assets.
Not at all.
It's fascinating how, like, the specific characteristics of each asset can influence these results.
It really can.
Now, remember, we've been focusing on SMAs.
We have.
The video analysis also explored using EMAs.
Yes.
Which, as we discussed, give more weight to recent price data.
Exactly.
I'm curious what you think. Like, what might be the impact of using EMAs instead of SMAs in this strategy?
Good question.
Well, if EMAs are more sensitive to those recent price changes, I would imagine that they might generate more signals.
They probably would.
Especially on shorter time frames, but I'm not sure if that would necessarily translate to better performance.
Good point. Let's see what the analysis showed.
Okay.
So for Bitcoin on the 1 hour time frame, the only profitable EMA combination was EMA 20 and EMA 120 with a modest 4.4% return.
Okay. But things got interesting when they looked at the 4 hour chart.
Okay.
The EMA 20 and EMA 60 combination took the lead.
Okay.
With a 64.39% gain.
Wow. That's a significant jump.
Big jump.
It seems like those EMAs might be better at capturing trends on that particular time frame for Bitcoin.
Seems like it.
What about the daily chart?
So on the daily chart for Bitcoin, the EMA 20 and EMA 60 combination also performed well, yielding a 23.87% return.
Okay.
Now let's shift gears and look at how EMAs performed on Ethereum.
Okay, I'm ready. Did the EMA 20 and EMA 60 combination dominate there as well?
So for Ethereum, the results were a bit more diverse.
Okay.
On the 1 hour time frame, the top performer was EMA 20 and EMA 120, reaching a pretty impressive 82.92% return.
Wow.
But on the 4 hour chart, the winning combination shifted back to EMA 20 and EMA 60.
Interesting.
With a 49.18% gain.
Okay.
And finally on the daily chart, EMA 20 and EMA 180 delivered the highest return at 5.73%.
So we're seeing even more variation. In the optimal combinations, when we bring EMAs into the mix.
For sure.
It's clear that the choice between SMAs and EMAs depends on a lot of factors.
A lot of factors.
It seems like finding the right combination is a bit of an art and a science.
It is.
It requires analysis, experimentation, and a good understanding of the market that you're trading in.
Couldn't have said it better myself.
Okay, good.
You've hit the nail on the head.
So this deep dive has provided me with like a solid foundation.
Absolutely.
But before I jump into trading, there are a few more critical aspects to consider.
Yes.
So what other key takeaways should I be aware of before I start applying these strategies?
Let's talk about it.
So what other key takeaways should I be aware of before I start applying these strategies?
Well, first and foremost, remember that backtesting is a simulation. Based on historical data.
Right.
The market's constantly evolving, so past performance doesn't guarantee future success.
So I shouldn't expect to just plug in these combinations and automatically start making profits.
No, you need to understand the nuances.
Right.
And that's where risk management comes in.
Okay.
It's crucial to use tools like stop-loss orders.
Okay.
Which automatically sell your position if the price drops to a certain level.
Okay.
Limiting your potential losses.
So even if I identify what seems like a really promising entry point based on, a golden cross, I should still have a stop loss in place just in case things don't go as planned.
Absolutely. Think of a stop loss like your safety net.
Okay.
It's a way to manage your risk and protect your capital, especially when you're just starting out.
That makes a lot of sense.
Yeah.
It's better to have a plan in place to limit losses than just ride a losing trade and hope it'll magically turn around.
Hope is not a strategy.
Okay, good.
Now, another crucial point is that the DMA strategy, while effective, is not a standalone solution.
Okay.
Successful traders often combine multiple indicators and strategies to get a more comprehensive view of the market.
So I shouldn't just rely on those golden and death crosses.
It's a good starting point.
Okay.
But there's so much more you can do.
What other types of indicators might I consider?
Oh, there's a whole world of technical indicators out there.
Okay.
For a beginner, some popular ones to explore alongside DMA could be the Relative Strength Index or RSI.
Okay.
MCD, or Bollinger Bands.
Okay.
Each indicator provides a different piece of the puzzle.
Okay.
Helping you assess momentum volatility and potential overbought or oversold conditions.
Okay, so it's about using those indicators in conjunction with DMA to get a more informed picture.
Exactly.
That seems like it could help me confirm signals.
Right.
And potentially avoid those false signals we talked about earlier.
Exactly. Now, remember that concept of overfitting that we discussed?
Yes.
It's important to be aware that a strategy that performs flawlessly on historical data might not do so well in live trading.
Right. It might have just gotten lucky on that specific data set.
Exactly.
Now, how can I test my strategy to make sure it's not just overfit?
So the video suggests a technique called forward testing.
Okay.
And that involves testing your strategy on a new unseen data set to see how it performs.
Gotcha.
This helps you validate your approach and make sure it's robust enough to handle different market conditions.
It's like a dress rehearsal before the big opening night.
Exactly.
You want to make sure your strategy can handle the unexpected.
Exactly. Now let's bring this all back to you as a new trader.
Okay.
The DMA strategy can be a valuable tool in your trading toolkit.
Okay.
But it's essential to remember that trading is a journey of continuous learning and refinement.
So I shouldn't be discouraged if I don't immediately start making huge profits.
Not at all.
Okay.
It's all about developing your understanding of the market, honing your skills, and learning from both your successes and mistakes.
This deep dive has been incredibly insightful. I feel like I have a much better grasp of DMA, and I'm excited to start experimenting and learning more.
That's great. Remember, focus on understanding the underlying principles of the strategy.
Okay.
Not just blindly following the signals.
Right.
And always prioritize risk management.
Right.
Protecting your capital is key, especially as you're gaining experience.
Absolutely. This has been a fantastic deep dive. I feel much more equipped to explore the world of stock trading now.
Awesome.
Thanks for guiding me through this.
It was my pleasure. I encourage you to keep exploring, keep learning, and most importantly, enjoy the journey.
That's great advice. Thanks for joining us on the deep dive. We'll be back next week with another fascinating topic, so stay tuned.